The Federal Reserve is about to make its next move, and markets are holding their breath. A quarter-point rate cut is almost fully priced in, but there's still a chance of a bigger half-point cut. Either way, the shockwaves could be massive. Here's why. Interest rates are the price of money, and when the Fed changes them, it ripples through every corner of the economy. Lower rates make borrowing cheaper, but they also send signals about economic health. Right now, the Fed is facing a weak job market. Only 22,000 jobs added last month, unemployment ticking higher. At the same time, inflation is still above target. That's a dangerous mix. If the Fed cuts too much, inflation could flare up again. If it cuts too little, the slowdown could accelerate. Either path could jolt stocks, bonds, housing, and crypto. For stocks, rate cuts can be a double-edged sword. Cheaper money can boost valuations, but if cuts are seen as panic, markets can sell off hard. Growth stocks often rally first, but defensive sectors can take over if recession fears grow. In bonds, a rate cut usually pushes yields lower, lifting bond prices. But if investors think inflation will stick, long-term yields might stay high. That can flatten or even invert the yield curve, a classic recession warning. Housing feels the impact too. Mortgage rates are tied more to long-term yields than the Fed's short-term rate. So a cut might not bring instant relief to homebuyers. If bond yields stay elevated, mortgage rates could remain stubbornly high. Crypto reacts differently. Lower rates can weaken the dollar, which sometimes boosts Bitcoin and altcoins. But if cuts signal deep economic trouble, risk appetite can vanish, dragging crypto down with equities. Now, I want to hear from you. Do you think the Fed is cutting because it sees trouble ahead? Or because it's confident inflation is under control? Drop your thoughts in the comments. And while you're here, hit subscribe. We post every Tuesday and Friday, breaking down the forces moving stocks, crypto, and everything in between. Back to the story. Global markets watch the Fed like a hawk. A US rate cut can pull capital out of emerging markets, weaken their currencies, and raise their borrowing costs. It can also shift exchange rates, making exports more or less competitive. Central banks from Europe to Asia often respond in kind to avoid currency shocks. This next move is especially tricky. The Fed is cutting into an environment where government debt is already high. Lower rates can ease debt service costs, but they can also encourage more borrowing. If investors start doubting fiscal discipline, they may demand higher yields to hold US debt. That could offset the Fed's easing and keep financial conditions tight. For everyday people, the effects will be uneven. Credit card and personal loan rates could drop quickly. Auto loans might ease a bit, but mortgages, student loans, and business financing may take longer to feel the change. Markets will also be watching the Fed's language. If it signals more cuts ahead, risk assets could rally. If it hints this is a one and done, the reaction could be muted or even negative. The wild card is confidence. If investors believe the Fed is acting from a position of strength, cuts can fuel optimism. If they think the Fed is reacting to hidden weakness, fear can take over fast. So, what should you watch? First, the bond market's reaction, especially the 10-year yield. Second, the US dollar index. Third, sector rotation in equities. And finally, crypto's correlation to stocks in the days after the decision. This is not just another policy tweak. It's a potential turning point. The wrong move, or the wrong message, could wreck markets in ways we haven't seen since the last major tightening to easing cycle. Thanks for watching. If you found this breakdown useful, like, share, and subscribe. And tell me in the comments what you think the Fed's real motive is this time.